money is an essential part of modern life. It's difficult to imagine a world without it, as it permeates every aspect of our daily existence. However, money as we know it didn't always exist. It has a rich history that spans thousands of years, evolving from simple barter systems to the complex financial systems we rely on today. Understanding the history of money offers insight into how economies and civilizations have developed over time. Before the invention of money, ancient societies relied on a barter system to conduct trade. Bartering involved the direct exchange of goods and services without a standard medium of exchange. For example, a farmer might trade a bushel of wheat for a pot made by a craftsman. While bartering was effective in small, self-contained communities, it became problematic as societies grew more complex. The main issue with barter was the double coincidence of wants for a trade to occur. Both parties needed to have something the other wanted. If a fisherman wanted bread, he would have to find a baker who wanted fish at that exact time. This created inefficiencies and limited the scope of trade. The need for a more flexible and universally accepted medium of exchange became apparent. To overcome the limitations of barter, ancient societies began using objects that had intrinsic value or were universally accepted. These early forms of money varied widely depending on the region and available resources. 1. Commodity money. Many early civilizations used commodity money, which included items like grain, livestock, and precious metals. The Mesopotamians, for instance, used barley as a form of currency around 3000 BCE. Livestock, such as cattle and sheep, also served as a medium of exchange in various cultures. These items had inherent value, as they were essential for survival and sustenance. 2. Metal money. As societies advanced, metal became a preferred medium of exchange due to its durability, portability, and divisibility. Ancient Egyptians used gold and silver as early forms of currency. The transition to metal money allowed for easier transactions, as it could be divided into smaller amounts and carried long distances without spoiling. The first true coins were introduced in the Kingdom of Lydia, in what is now modern-day Turkey, around 600 BCE. These coins were made of a naturally occurring alloy of gold and silver called electrum. They were stamped with designs that indicated their value, making them the first standardized currency. Coins quickly spread throughout the ancient world, as they solved many of the problems associated with earlier forms of money. Unlike commodities like grain or livestock, coins were durable, easy to transport, and didn't perish. They also eliminated the need for direct barter, as their value was universally recognized. Coinage became widespread in ancient Greece and Rome, where it played a crucial role in the expansion of trade and empire building. The Greeks were known for minting coins of various metals, including gold, silver, and bronze. These coins were often adorned with images of gods, goddesses, and important political figures. In Rome, the use of coins became even more sophisticated. The Roman Empire established a highly organized monetary system that allowed for the standardization of currency across vast territories. The Roman denarius, a silver coin, became the standard currency throughout the empire and was used for centuries. Coins not only facilitated trade but also served as a tool for political propaganda. Emperors would mint coins with their own likeness, using currency to reinforce their authority and legacy. The next significant development in the history of money came with the invention of paper currency. The Chinese were the first to introduce paper money during the Tang Dynasty 618 to 907 CE. Initially, paper money was used as promissory notes, representing a claim on a certain amount of coinage or precious metal stored elsewhere. Over time, paper currency became more widely accepted as a medium of exchange. The introduction of paper money had a profound impact on trade and commerce. It was much easier to carry and transport compared to heavy metal coins. Paper money also allowed for larger transactions, facilitating trade on a broader scale. Europe eventually adopted paper currency in the 17th century, with the establishment of banks that issued banknotes. These notes were initially backed by precious metals, but over time, governments began to issue fiat money currency that has no intrinsic value but is accepted as legal tender by decree. By the 19th century, many countries had adopted the gold standard, a system in which the value of a country's currency was directly linked to a specific amount of gold. This provided stability to international trade, as currencies could be exchanged based on a fixed rate of gold. However, the gold standard also limited the flexibility of governments to respond to economic crises, as they were constrained by the amount of gold they held in reserve. The gold standard was eventually abandoned during the 20th century, particularly after the Great Depression and World War II, when it became clear that more flexible monetary policies were needed to manage economic fluctuations. With the decline of the gold standard, most countries transitioned to fiat money, which is currency that has value because a government maintains its value, or because two parties agree on its value. Fiat money is not backed by a physical commodity, such as gold or silver, but is instead based on the trust and stability of the government that issues it. The rise of modern banking further facilitated the use of money in everyday transactions. Banks began to offer services such as checking accounts, savings accounts, and loans, making it easier for people to store and manage their money. Central banks, like the Federal Reserve in the United States, were established to regulate the money supply and manage economic stability. In recent decades, money has continued to evolve with the advent of digital technology. Electronic payment systems, online banking, and credit cards have become increasingly common, reducing the need for physical cash in everyday transactions. Digital money allows for instant transfers, global transactions, and greater convenience. The emergence of cryptocurrencies, such as Bitcoin, represents the latest development in the history of money. Cryptocurrencies are decentralized digital currencies that use blockchain technology to secure transactions and control the creation of new units. While still relatively new, cryptocurrencies challenge traditional notions of money and finance, offering an alternative to government-issued fiat currencies. The invention and evolution of money were driven by the need for a more efficient way to conduct trade. The barter system was limited by its inefficiencies, and early societies needed a standard medium of exchange that could be universally accepted. Money made trade easier by providing a common measure of value, a store of value, and a unit of account. Money also enabled the development of more complex economies. It allowed for specialization, as individuals could focus on producing specific goods or services and trade them for other necessities. This led to increased productivity, innovation, and economic growth. Furthermore, money played a crucial role in the formation of governments and empires. It enabled the collection of taxes, the payment of soldiers, and the financing of public works. Without money, the large-scale organization of society would have been impossible. In conclusion, the history of money is a story of innovation and adaptation. From the earliest barter systems to the rise of digital currencies, money has continually evolved to meet the changing needs of society. Its development has been central to the growth of civilizations and the functioning of economies. As we look to the future, it's likely that money will continue to evolve, shaped by technological advancements and the changing nature of global trade. However, its fundamental purpose to facilitate exchange and store value will remain constant.